So again, I want to say a special thanks to Bob Milanowski for being with us today and taking us through this presentation. Again, it's don't put your eggs into one basket, how to diversify your trading. And so Bob, if you're on the mic, I'm going to turn it over to you at this point.
Thanks, Brian. I believe I'm on the mic, and it looks like I'm coming through according to my monitor here.
Yep, you're good to go.
Great. Well, thanks for the introduction. I just want to say a couple words about who I am. This is Bob Malinowski. I was a NetPicks client for 4 years and bought just about everything they had. And after working with them for a number of years as a client, I became a coach about a year and a half ago. And the background that I bring to the NetPicks team is that I do a lot of, actually a lot of options trading. It was through NetPicks that I learned about futures trading. But the same principles I used with my options trading, I continued with the futures and continued to expand my trading repertoire and the markets that I trade and the people that I talk with on a weekly basis with the NetPicks team. The title today is Don't Put All Your Eggs into One Basket, How to Diversify Your Day Trading. The reason I chose this topic is that as day traders we tend to focus on usually just one or two markets, and I wanted to show some opportunities that may be available that a lot of us may be missing by focusing on just a couple of markets. Let me try. Okay, so today's agenda, I'm going to talk a little bit about stock portfolios because that's where people usually start when it comes to diversification and trading in general. Talk a little bit about the types of diversification, and then what type of opportunities are available to us as day traders, some of the unique opportunities that we have to take advantage of diversification. And I've, in walking through the examples today, I put together a sample trade plan with some very typical performance metrics. Nothing fantastic, but nothing small. You know, just like a typical plan that you may expect from a typical day trading trading plan. And then I'll wrap up with some advantages of diversification as it relates to day trading. Okay, very briefly, I just want to go over some stock portfolio diversification that we may all be used to hearing. You often hear that you should have 10 to 20 stocks in your portfolio, and some experts even suggest 20 to 25. The reason that this is suggested is that you don't want to put all your eggs in one basket. There's a lot of market risk with an individual stock. A news report can come out and the stock can tank overnight before you have an opportunity to even react to it. The stocks may also, the reason you want to have a number of stocks is because you want to take advantage of diversifying yourself in different fields, different sectors, different industries. When we are looking at stock portfolio diversification, generally speaking, investors are only in long positions. They simply buy stocks and they hold them for a fairly long period of time, more of a position trading. That's another reason that stock portfolio diversification requires a lot of stocks, because stockholders tend to hold stocks for a long time, and they go up and down and they go through cycles, and so you need more than a handful of stocks to weather those cycles. Another aspect of stock portfolio, stock diversification, long-term trading that's different from day trading is that the average stock is considered by many to be about 80% correlated to the overall market. And many of you that have IRA plans or 401k plans are painfully aware of this for the past 3 or so years. When you come home in the evening from a long day's work and you hear the stock market's down 500 points, you're not thinking to yourself, well, gee, it probably only affected 1 or 2 of my stocks. No, you're probably thinking, well, there goes my 401k or my IRA, because I tend to be invested in stocks, and stocks tend to track or correlate with the overall market at a pretty high degree. Okay, one of the advantages that has recently been introduced to the area of stock trading has been the addition of these ETFs. This has greatly improved our diversification opportunities with stock trading, long-term trading. We now have opportunities to trade currencies, commodities, foreign markets like Brazil or China, emerging markets, and a fairly recent and a new area to a lot of stock investors are inverse ETFs. As I said near the top of this chart, stock investors tend to be long only. Well, now with inverse ETFs, you have the opportunity to actually take advantage of markets moving opposite the direction of your investment ETF. But still, most people with stock portfolios tend to go long, and hold on for a long period of time. And risk management is limited to basically the management of the balance between these positions and how much I want in my positions and how much I want in cash. So that's where we are basically with stock portfolio diversification. Day traders have actually a greater opportunity, though, when it comes to diversification. But unfortunately, for many day traders, particularly those just starting out, it's often not a priority. It's not the first thing a day trader thinks about is diversification. They think about getting rich, or the Holy Grail, doing some quick trades to make a few quick dollars, and then build that up to a trading business where I can make money every day. That's generally how people start in day trading. But again, day traders have a short trade time horizon, but day traders need to always consider a long-term long-term trading perspective so that their accounts grow. We all want our accounts to grow long-term, even though we're looking at very short-term time horizons for the actual trade. Another issue with day traders is that starting out is typically accounts are smaller than longer-term position accounts. Most of us here probably have smaller trading accounts than we have IRA or 401k plans. And again, that tends to cause us to trade a little differently than we do in these larger accounts. We tend to risk more per trade. This is particularly true in Forex. A number of you that have started off in Forex may have started off with a $500 or $1,000 account and blow it up in a few weeks or even a few days. Again, you would never do that with an IRA, but for some reason day traders tend to be a little riskier with their smaller accounts, and that's something we do not want to do. We do want to be in this for the long term, and even though we have a short time horizon for the individual trade, we need to maintain that long-term perspective. The good news for day traders is that we actually have a greater opportunity for diversification than the long-term position traders, and therefore we actually have a greater opportunity for risk management. Some of the opportunities available to day traders are, of course, very simply expanding the time horizon, going into swing trading, a 2 to 3 day trade or a week-long trade, or even position trading like a typical stock trader, holding positions for weeks or months. Typically, a stock trader that's a long position holder does not diversify by going into day trading. It's usually the other way around. A day trader, because the day trader is trading every day, has an opportunity to actually place some positions for longer-term trading. So that's an area of opportunity that we have. The markets available to us as day traders are great as well. Of course, we have stocks, and as day traders, we like to look for high trading volume stocks with fairly high volatility, so that we can get in and get out quickly and easily and see some movement in that stock. But in addition to stocks, day traders have futures available to them. We've got the stock indexes, the Dow, the Russell, NASDAQ, even overseas stock market indexes like the DAX. We can trade commodities like the grains or agricultural materials, the metals, energy stocks like crude oil. And then we have treasuries. These are just a few. Forex. A number of you have started day trading through the area of Forex. Forex actually offers some very unique and some very positive benefits for day trading. And the other thing we have as day traders is that we have systems. Most stock traders pick stocks based on some type of recommendation, maybe a technical analysis, maybe a fundamental analysis. But as day traders, we use systems, and we are generally system traders. We have one or hopefully more systems that we have available to us that we can take advantage of. And this allows us, again, for greater diversification opportunities in our day trading. Okay, our systems. We can have a trending system, a fading system, maybe trading between the high and low of a channel, or even some scalping systems. A lot of you listening to this presentation may be NetPicks clients and are aware that most of the NetPicks products are trending systems. We look for a breakout and try to take advantage of a move in an underlying market or future or a Forex instrument that's trending in a positive way for us. Another opportunity we have with day trading is time of day. We have different trading sessions. This is really, really great for us because we can trade anywhere in the world. Because at anywhere in the world, there are different sessions available to us and different opportunities. I'm here in the East Coast of the United States, so I tend to look at early morning futures trading and the stock indexes on the New York Exchange when they open up, and some of the grains during the mid-morning. But for folks that are in Asia, you can trade the Asian market. You can trade different times of the day, even in morning or evening. You can trade at any time that suits your particular schedule. Another opportunity we have is actually the day of the week. We can actually look for trading particular news events that occur. This can be political announcements or Fed announcements, or we can follow scheduled reports like the first Friday jobs report or the Wednesday weekly crude oil report. And finally, with day trading, we've got an opportunity to take advantage of different charting intervals. We can look at time bars, tick bars, volume bars, range bars, Renko bars. Many of you are already trading a number of these, and these different charting intervals provide us other opportunities for trading because it diversifies the way we look at an instrument, and by diversifying the way it's charted, you can take advantage of what each of these trading intervals has to offer in the way of putting together a positive trade plan. I'm going to go into the kind of the meat here now by starting with this chart here. Here's a chart I put together on a trade plan I'm going to show you in just a minute, and it shows 25 trades. And just for the sake of argument, I'm going to say because it's all fairly arbitrary, we're going to look at trading 5 day trades a day. So let's say we're a day trader and we do typically 5 trades a day. 25 trades would be 1 week. And looking at this chart, your immediate reaction would be, why would I want to trade this trade plan? It looks pretty much like a loser to me. And for this week, it's definitely a loser. It was only up, looks like on the end of the first day, maybe the beginning of the second day, and pretty much down from there. If I was trading this plan, I would probably be tempted to simply toss this plan and go on and look for another opportunity. This is one of the disadvantages of day trading. We're so close to our trades that we oftentimes don't see the forest through the trees. This trade plan right here comes from a performance plan I put together that I'm going to be using through the presentation based on what I think is a very typical trade plan performance set of metrics. I put together a plan with a probability of win of 67%. In other words, the total winning trades divided by all the trades is about 2/3. That's a fairly typical trade plan that we see in many of our plans that we put together. I have an average win of 50. I'm going to call these 50 units. They can be dollars, they can be pips, they can be ticks, they can be whatever you want. I'm going to just call it 50 units. Maximum win of 100, average win of 50, an average loss of 40, a maximum loss of 80, and a profit factor of 2.5, meaning that my win percentage times the average win over the loss percentage times the average loss is about 2.5. Another way to look at profit factor is it's my gross winnings over my gross losses. 2.5 is fairly good, and you can make a pretty decent living with a profit factor of 2.5. And with these parameters, I have an average profitability of 20 per trade. Okay, this comes about from statistical expectancy. My win percentage is 2/3. My average win is 50. My loss percentage is 1/3, and my average loss is 40. And when you make that calculation, you get an average profitability per trade of 20. So, in summary, here's a trade plan where I'm winning 2/3 of the time. My average wins are greater than my average losses. I've got a profit factor greater than 1, which is a requirement for a winning plan. It's 2.5. And I have an expectancy of winning about 20 per trade, call it $20 per trade. This is what this equity chart would look like if every trade yielded me say $20 per trade. After 60 days of 5 trades per day, that'd be 300 trades. I'd have $6,000. Now, that's a very nice, smooth perfect equity curve, and I'm sure one that all traders aspire to, but it's not reality. Reality is I'm winning trades and I'm losing trades. This next chart shows, okay, what if I were to win 2/3 of the time and lose 1/3 of the time? And it happened just like that. Win, win, loss. Win, win, loss. Win, win, loss. Okay, I win 2 in a row. My average win is 50, and then I lose 1. Average loss is 40. Same basic shape of the curve. There's a few more little wiggles in it because I'm winning and I'm losing. Again, this is not reality either, because my distribution of trade wins and losses is not nice and smooth like this. I've got, as we all know, periods where I have winning streaks and periods with losing streaks. Here is a more typical curve. I took that trade plan and simply with a basic random number generator generated an equity chart showing what a typical trade plan would look like, what a typical equity chart would look like if I had 2/3 wins, 1/3 losses, average win of 50, average loss of 40, profit factor of 2.5. This is what it would look like. Now, this still looks good. A trader should look at this forest of trades and say, wow, well, I'm still make $6,000 at the end of 60 days. It's still basically going from left to right in a mostly 45-degree angle. There are some little jags, but I can live with this. The area that I've circled, though, that is the area where that 1 week took place, right here, where I had this fairly miserable-looking week. But again, going back to my chart, this is more typical. This is what we can expect. Now, why am I bringing this up? You may be saying this is obvious. The reason I'm bringing it up is that diversity allows us to smooth these trades. It allows us to smooth out this chart so that we don't experience weeks that look like this, at least not very often. And so that's the advantage. The problem here is many traders get shaken out. When they get a week that looks like this, they stop. They look for the next trading vehicle. They look for the next plan. They look for the next guru. They toss it out and say, well, this system, is not worth what I paid for it. This is particularly a danger if this is the first week you're trading with this system. What we need to do as traders, particularly as day traders, is to think about what the plan will look like over the long term with an equity chart that looks like this. Okay, another one. Here's the same basic parameters, same 2/3 win, 1/3 loss, 2.5 profit factor trade plan. Another chart, very typical. Again, this time a little over 6,000 at the end. And the expectation is that with $20 per trade, I'd be at 6,000 at the end of 300 trades or 60 days. Again, we got a period here that doesn't look too happy. And again, it looks like this. As a day trader, and this is frustrating. If you're only trading one market, at the end of this week, you'd feel kind of miserable. You think, oh, gee, maybe I should be looking for another job or another market. And again, it can be frustrating and cause people to throw in the towel earlier than they should. Here's another chart showing the same basic plan, different data though, and you can see here's another area. Basically, well, this one didn't quite make $6,000, but it's all part of the odds. You win some, you lose some. But here's a period where it looks like a couple of weeks went by where we really didn't meet new equity highs. And again, if you're trading this, you may be tempted to throw in the towel. That period looks like this. Again, this week would be kind of frustrating. You're up, you're down, you're up, you're down, but you ended up being down for the week. Now, why does this happen? This happens because even though the odds are 2/3 that we're going to win and 1/3 that we're going to lose, we don't have a smooth distribution of wins and losses. That distribution is completely out of our control. We have no control over what the market is going to do in the short term or the long term. We have no control whatsoever. All we can do is take a stand, again, looking at the forest and say, yes, I'd be happy with a curve like this, but realizing that in real life, markets move quickly, then they stop and they consolidate, they chop, then they trend for a little while, then they chop for a while, and we have no control over that. We have no control over that, and that's what causes um, areas of our charts, areas of our trading, days or even weeks to go by where we don't realize the kinds of gains that we expect with the plan that we put in place. This chart right here, you can see we had some periods here of nice trending. So if you're trading a system that did trending, you'd see a nice trend right here. If it went into this consolidation here, maybe you'd have a number of trades that are losing. Looks like we had a breakout here, but nope, it was a failed breakout, more chop. Nope, some more trending here. Looks like the beginning of a trend here that failed, and then a pickup of another trend here. We have no way of knowing that we're about to enter a consolidation phase or enter a trending phase. We can only look back and see that it has consolidated or that it has trended, but we have no control. We, one, have no control over it, and two, we have no way of knowing that the next trade doesn't take us to another trading environment. Right here, at the end of this choppy consolidation area, we had no idea that these bars are here with the beginning of a nice trend. And if we are trading a system that looks at trends and breakouts, then we'd have that opportunity to trade that section right there. So that's the reason our charts will look like this. We don't have nice, perfect, smooth charts like this that show, well, I win two, I lose one, I win two, I lose one. Because we've got periods where we are trending and we're consolidating, we're in a winning streak and we're on a losing streak. This is probably one of the hardest parts for day traders to battle. It's the psychology behind these losing streaks are very difficult. And I have to admit, for me, starting out as a day trader, this was very difficult. And I oftentimes said, this system's no good. Toss this out. Look for another market. Look for another guru. Whatever. When in fact, this is actually a very good plan. And if I just stick with it, I'm going to realize a very nice profit. And nobody would argue with that curve that that's a very profitable curve. Even though there are periods where the drawdown may last for a couple weeks. There are periods where there's very little gain, but there are these nice periods here where we get a nice trend up. So next area I want to talk about a little bit is correlation, because when we choose to trade more than one market, you want to be aware of the correlation that exists between one market and the next. The reason I want to bring this up is that the lower the correlation, the more loosely coupled the markets are, the greater the opportunity there is to smooth out that equity curve. A correlation, in our trading world, it's really linear correlation that I'm going to be referring to, is a statistical relationship that involves the dependence between two variables or two markets. Okay, it shows how strongly the movement in the markets are related. As traders, we don't care if it's a causal relationship or simply a coincidental relationship, or maybe it's linked to something else. It doesn't matter. Well, all we care about is how correlated are they, and it doesn't matter what the reason for the correlation. I'm not going to dive into a lot of the math, but I just want you to be aware of this basic mathematical concept of correlation. There's a variable known as R, which is a correlation coefficient. And this number is expressed as a value between -1 and 1. Sometimes it's referred to as -100% and 100%. When the value is 0, there's no correlation. It's like a random, what happens in one market doesn't affect the other. What happens in one market will give you no clue as to what's going on in the other. So that's no correlation. Correlation coefficient of 1 is perfectly correlated. When A goes up by 10%, B goes up by 10%. It means they're 100% in lock sync. An example of this might be very close to, let's say, a forex pair like the Euro USD and Euro futures. Okay, two completely different instruments. One's a future, one's a forex, one's a spot, and one's a contract. But they'd be correlated because they're both we're essentially entering the market of buying euros and paying for them in dollars. So those would be perfectly correlated markets, or very nearly perfectly correlated. And a -1 is inversely correlated. This is where as one goes up, the other goes down. Okay? So this would be an example of a correlation between two markets of 100%. As one goes up, the other goes up. As one goes down, the other goes down. These charts are simply meant to just kind of give you a sense for what these correlation coefficients will look like with two markets. With R around 80%, you can see, okay, as one goes up, the other one kind of goes up. They're pretty close. You can kind of see that there's a trend between these two and draw a line and say, yep, that's about an 80%. Here's an example of a minus 60%. You see the dots are more scattered, but they kind of point from upper left to lower right. So there's an inverse relationship. That's why the correlation coefficient is negative. But there's more scattering, so the number is closer to 0. Finally, if there's no correlation between two markets, the correlation is 0. You can't even draw a line trying to connect, or show the relationship between these dots. These correlation coefficients are based on statistical sampling, covariance, and standard deviations, and you're welcome to investigate the math further. But as traders, we just really need to be aware of it, not so much the details of the mathematical concepts that go into them. The bottom line is that 0 is uncorrelated, 1 is 100% correlated, and minus 1 is also 100% correlated, but simply the inverse relationship. There is a place on the internet that shows at a glance some forex correlations, and this is a website called forexticket.co.uk, and on that homepage there's a button you can click that says forex correlation. And this is really nice because this presents correlations for various time frames. I simply put a little picture of the 5-minute correlation here just to demonstrate how forex pairs are correlated. And across the top you can see the Aussie USD and the Euro Yen and Euro USD, etc. And down the side, the same pairs are represented, and at the intersection of each of any pair, you find the correlation that exists for this 5-minute interval that was charted here. And again, this is on their website. But as you can see, along the diagonal, everything's 100% because the Aussie USD is 100% correlated with itself, obviously. The nice thing about forex trading is there are tools like this that you can go to, and you can see what the correlations are between different pairs, and why you may want to pick a couple of pairs that are not correlated when you want to diversify your forex trading. Basically, if it's above 80, it's high, and the markets tend to move in the same way. Or if it's below 80, they move in the same way but in opposite direction. I mean, they move in the opposite direction, but they're highly correlated. Anything below 60 is low and considered to be, fairly uncorrelated and a good opportunity for diversification. Okay, now the reason I want to show you this is those first two charts that I showed you earlier on. Let me jump back to them quickly. Let's see here. Okay, this chart right here, this equity chart for market number 1. Get a kind of picture in your mind what this looks like, the ups and downs and the jaggedness of it. And then here's another one for market number 2. And what I've done here is I've shown what happens when I diversify my trading by combining these two markets. Okay, right off the bat, you can see it's a smoother curve. This still has a total gain of 6,000, but notice how much smoother it is. There are fewer areas where the drawdown lasts, 2 weeks. And where there are drawdowns, notice they're much smaller. These are two uncorrelated markets, and by combining the trading of these two markets, I realize a much smoother equity curve. So this makes me feel better. I don't have as many days or weeks where I'm trading in the red, and it simply makes trading a little easier for me. Again, started off a little jagged down here, but very little negative equity in the beginning, and a fairly nice smooth curve up. By adding the third marker that I showed you, I get this chart right here. Notice it's a little bit smoother than the 2 trade, but not a whole lot more. And again, my point here is to show diversification by even just 2 markets can make a huge difference in how smooth your equity curve is. So if you're a day trader now and you're trading just the S&P 500, you're trading just the Russell or just crude oil, and you have some very challenging weeks where you just want to throw in the towel or you get frustrated, I would strongly consider adding at least one more market. One more market can make all the difference in a trading equity curve. Okay, that would be this example here of adding just one more market. Now remember, this was the ideal market. This was the one where every trade I yield $20. And notice that with 3 markets, I'll just kind of flip back and forth. Notice it's done a pretty good job of approaching that line. The more markets you add, the closer you're going to get to a smoother trading curve, because the ups in one market will be offset by the downs in the other market. A consolidation in one area may be offset by a breakout in another market. This is why you want to choose markets with different, markets that are non-correlated. Because if one market is trending, you don't want the second market to also be trending. If the other market is highly susceptible to the jobs report on Friday and you trade Fridays, you don't want your second market to be susceptible to the same report. So again, being aware of market correlation and what that concept means, and allowing a trade plan to include more than one market can really greatly help smooth out these curves. Okay, mathematically, you have a smoother equity curve, and this is particularly good with Forex. You Forex traders out there will really appreciate this. Instead of placing the same risk per trade, if you're going to 2 markets, place half the risk per trade. So mathematically, you get a smoother curve and a smaller risk per trade. The psychological benefits can't be overstated. The smaller drawdowns, less time in a drawdown, all of this easier on your trading psychology. I consider this, if there is a holy grail of trading, it's really reducing the psychological impact of trading. And I believe that this diversification can really help. Okay, now what are some examples? 2 markets. Okay, one way to diversify is to pick 2 markets at the same time. Now, for me personally, I don't do this because I find it difficult to focus on more than one market. I get kind of emotionally wrapped up in a trade. I'm watching it, and it's hard for me to keep 2 in mind. But I have done it in the past, and if you're planning to do 2 at one time, maybe your trading opportunities only allow you 1 session in the day, and so 2 markets would make sense. Pick a volatile market, like let's say crude oil or an index or a commodity or something. And then if you want to add to that market, I would suggest a slow market to add to that. For instance, a treasury future, something that you've got plenty of time to adjust, plenty of time for you to set up your trade, plenty of time to put your stops and your targets and to move during trade management. So 2 markets at one time. Pick a treasury and then pick something that's not correlated well with it at all. Maybe a stock index future or an energy commodity. This is actually quite doable. We've got a number of our coaches have done this, and trading the slower market in conjunction with the more volatile one will work. Another approach, this is an approach that I personally take, is trading 2 or more markets in succession. Okay, again, I said I was on the East Coast, so if I'm up real early, I may want to trade Forex on the European in the European session, and then switch to crude oil futures, between 8:30 and 9 Eastern Time in the morning. And once 9:30 rolls around and the stock market in New York opens up, I can trade stock index like the Russell 2000. And maybe mid-morning, pick an agriculture like a wheat or soybeans. This is actually quite doable. This is really quite doable. And again, if you're trading one instrument at this point, you may want to consider adding another one either at the front end or the back end of your trading session, and add that to your trade plan. And then at the end of each day, at the end of each week, you should be able to notice that your combined equity gain and loss will be much more smoothed out. You'll see a smoother curve, and at the end of the week, you'll have more weeks. You'll have more weeks that are winning weeks than losing weeks. More winning weeks than you had in the past, and with just 1 or 2 additions, you may even be able to eliminate the losing week altogether. Again, with day trading, we can't expect every week to be 100% a winning week. in that first couple charts I showed, even a very solid trade plan with great expectation and a good 2.5 profit factor can still yield weeks that are going to be negative. So then look at the performance results, by day and by week as well. I strongly recommend analyzing all your trades. Some type of performance tool. NetPicks has something called the Universal Trade Analysis. It's a great tool, but any way that you can analyze your trades and observe them and plot them is going to make all the difference in the world. So you want to pick a couple of markets, and this final area I suggest maybe pick a couple of markets that you trade on different days. The reason I brought this up, I have not actually done this, but in using the performance tools that I've used, I've noticed that some of my markets actually do better on Mondays and Wednesdays, or Tuesdays and Thursdays, or just don't work well on Fridays at all. And if you're trading a single instrument, and you're analyzing it through a tool like the UTA, and you're noticing there's a day or two each week that it just doesn't perform that well, well, you may want to consider simply not trading that market those days of the week and pick another one and find one with some back testing that looks like will be profitable on those days. So another way to diversify your trading is to pick a couple of markets that are traded on different days of the week. And again, with some analysis and back testing, you can judge yourself if that will be a profitable a trading plan and one that will smooth out your equity curve. Because really, in the end, I'm looking for a way to smooth out the curve to make trading just a little bit easier for me. Just a couple words about system trading. When we trade systems, like NetPick systems or your own developed systems or anyone's systems out there, these are based on a positive expectation, that certain conditions are going to repeat themselves often enough that you can make a profit in the long run. Okay, and we need to keep in mind that we want to be looking at this forest, not at the daily trees, not at each individual trade, because that can get quite frustrating and nerve-wracking. You want to keep a bird's eye view, looking down on the forest, because we can never predict the next trade. We don't know that the next trade is going to be the beginning of a breakout or the beginning of some chop and consolidation. We don't know that. We can look back and see that, oh, we are in a trend or we are in consolidation, but you can't look forward and say it's going to continue. When we are system trading, we are looking at the long term, and we're looking at a positive expectation that what makes our system profitable will continue to repeat itself often enough that we can make a profit. Therefore, you want to always lean on the system, no matter what plan you put together, whether it's trading multiple markets at a time, or markets in succession, or different markets on different days of the week, or the same market with different time intervals on your charts. You want to always trade consistently, and after back testing has shown it to be profitable, lean on the system and let the system do its thing, essentially. Okay, that's basically what I had prepared for today. You're certainly always welcome to contact us at netpicks.com, info@netpicks.com. We have a phone number posted there and our address there. Today's session was really just to kind of open up the possibilities of day trading diversification to you, and for you to consider multiple markets and time frames and maybe systems or what have you as a way to smooth out that equity curve, and in the way I look at it, to really help with the trading psychology that I think all day traders battle on a daily basis. And it's a battle that we need to overcome. And I believe that diversification is one way, and a very good way, to combat that. Okay, let's see, I've gone about 40 minutes. I haven't, I'm looking at these questions here, I'm not really sure I see any. Maybe one of the other coaches can, I don't know if there's been questions that have been answered or where.
Hey, Bob, this is Brian.
Yes.
What I will do is I'll kind of go down through the questions here and read them to you, if that's
okay.
all right, and then you can respond.
Okay, great.
And so one of the questions was from Orville, he was asking if you could give the link for that 5-minute Forex correlation matrix.
Yeah, there's a place here. There's multiple places on the internet you can go. This is a fairly new one that actually Mark Silverman had pointed us to a few weeks ago that I found quite interesting. If you're a Forex trader, there's a lot of great information on this website. It's called forexticket.co.uk. And this chart that I brought up here on the front page, there was a link called Forex correlation. And again, if you're a Forex trader, the nice thing about Forex is you can reduce your trading size so easily by trading, fractions of whole lots, minis and micros and et cetera. So that's really a great site for that.
Okay. Next question is from Anna, and she's asking which of the NetPix systems is the speaker trading?
I've traded all of them. I'm currently trading the SST and the Keltner bells. You can trade any system. You can trade the UT, the Ultimate Trading Machine, Ultimate, you name it. Any system that NetPix has come out, they all work. They all have positive equity curves. But the ones I'm trading are the SST and the Keltner bells.
Okay. And I think she continued on with the question. I just located it. She's asking if you should do FX daily, swing trading. She's just asking for some guidance there.
Is this guidance on the correlation? Let's see.
It's in regard to the system. I guess. Let's see. It's really not a fair question. She's asking if you could explain which system to choose, FX daily or swing trading.
Oh, well, let me tell you, this is what's so great about, I'm not going to make this an advertisement for NetPix, but I mean, NetPix is a company that does provide so many trade plans, sample trade plans, and systems that you can customize to your own trading style. If you are a day trader, you can day trade. A swing trader, you can swing trade. I also do options trading. I use the SST to swing trade options. This presentation was focusing on day trading, but whatever your style is, if you've got a full-time job and you can only do swing trading because you can beat your computer only 1 or 2 times a day, do swing trading. If you've got the time to be at your computer for a stretch of a couple hours at a time, do the day trading. Supplement it with some swing trading. These principles I've outlined of diversification apply to any market, any trading style. I simply want to focus on day trading here because day traders tend to start off and oftentimes stick with only one market, and that'll work. I mean, you can see from the equity chart, one market with a good profit factor that'll make you money. But I'm simply suggesting you may want to consider more than one to smooth out that curve a bit, make those drawdowns a little smaller. The smaller drawdowns also allow you to add a little more risk because part of the issues with risk management is, particularly with day traders, is you don't want to blow up the account. You don't want to risk so much that there's that chance that 2 or 3 trades in a row you're wiped out. So again, to answer your question, the principles apply to all trading styles. I recommend you trade the style that best fits your your life.
Thanks, Bob, for that. Another question from Wouter, I think, and I'm going to answer this, Bob. He's asking the question here, any chance we could get the SST programmed for Think or Swim? Well, we will definitely give it a shot. I'm going to tell you that our most recent endeavor to get Keltner bells programmed on Think or Swim is really hit a roadblock. And the issue there is the back office programming language that Think or Swim has is hugely limited. Some of the things we're doing behind the scenes, I know you don't care as an end user, but there's a lot of stuff going on behind the scenes to run these calculations. And what we found, we had an expert in ThinkScript who is just totally stumped on how to accomplish some of the calculations we need to do. And it has to do with array processing. I don't want to bore you with that. Basically, Think or Swim cannot handle arrays, and that's a key thing you need when you're trying to set up these indicators and do the calculations we need to do. So we'll give it a shot. I'm not going to guarantee that we'll be able to get anything accomplished.
Yeah, let me add something to that, Brian. Let me just add something there. TradeStation was developed as a charting tool, a platform for for charting. It's back, and it was developed that way. It got into brokers and trades after that. Thinkorswim came from an options market development standpoint. They started out as two complete separate tools. I personally think you need to treat your trading as a business. Consider TradeStation as a premier charting tool. Take full advantage of that charting tool and place your trades on TradeStation. I do that with my options trade. TradeStation, I'm sorry, on Thinkorswim. Thinkorswim is a great options platform and provides lots of tools for trading options. And TradeStation is a great charting platform. And so, again, consider your business toolkit to include, more than one.
Yeah, Mona making a statement in regard to Thinkorswim, saying that they've been having a lot of charting problems since their acquisition by Ameritrade. So
yeah,
I've heard that same thing.
I've had a few issues with them since the acquisition that I never experienced before. But they're still a great tool.
Yeah, it's a great tool. It's an awesome tool for trading options. Frank's asking a question here. I'm going to shout it out here to you, Bob. What is the main commodity market for dollar, e.g. crude oil or gold? Are all of these parallel or correlated to each other, or the opposite? Is the trend movement for all these markets the same?
Okay. I'll just put it something like this chart here. Yeah, basically, I mean, this is something that you kind of notice. Most of these markets are not so correlated that it's going to make a lot of difference to you. Believe it or not, even an 80% correlation like this chart shows here, which shows these two vehicles trading, one's fairly correlated to the other, it will still create quite a remarkable smoothing in your curve, because there's always little nuances that take place. Even though they're correlated, then even as high as 80%, you could still get smoothing, because it would have to be 100% correlated for it to make no difference at all. And any difference at all, any correlation, any non-correlation at all, will aid in the smoothing to a greater extent than even I thought when I first started investigating it. That's why those charts where I showed the combining of two markets and then combining three, you didn't notice a big difference. I mean, there was a difference. It was smoother. But it's amazing how just a couple of markets, even loosely correlated, can provide a great smoothing. So to answer your question, these correlations like gold, gold goes up when, you name it. If interest rates go up, gold goes down. Or if the stock market goes up, gold does this, or oil does this. You hear that stuff all the time. The problem is those relationships kind of change over time, too. We go through different periods where gold seems to be coupled more to, the dollar. And then it kind of breaks away. Particularly these days when there's so many issues going on in the world, we never saw the European markets affect U.S. markets to the degree they're doing now. So my answer would be, take a look at the charts yourself. That's a really good way to do it. Bring up a chart. If you're going to trade gold and you're going to trade oil or an index future, bring a couple of them up, bring them up in your trading platform, and just look at them and see if it looks something like this, where they're loosely coupled. Or, does it look more like this, where there's hardly any correlation at all. But believe it or not, even something loosely coupled like this can add diversity to your trading. And certainly anything that's 60% or less, you're good to go.
Okay, I've got one last question here, and let me just put this out there. We're going to start to wrap things up. If we missed your question for some reason, go ahead and put it into the text. We'll take a few more minutes here and get those all answered up. And this question comes from a longtime NetPicks customer, Levi. He's asking, can one mix stock options with trading indices and have that be considered correlated?
Stock options, I mean, it depends on the stock option you're trading. I mean, you can pick, maybe you're trading Apple stock options and the NASDAQ future. Well, obviously, Apple's on the NASDAQ, and there's a correlation, because if the NASDAQ goes up a lot, then you kind of expect Apple to go with it and vice versa. Again, there's that kind of 80% that, stocks tend to move with, with their corresponding market. But I would consider an index and a particular stock, especially if the stock is on the index, yes, it will be correlated. But even that amount of diversification will help smooth out your curve. I'd be careful, though, about, if you're a stock trader, just doing a bunch of high-flying NASDAQ stocks on on their own, unless you're day trading them in an uncoupled way. Maybe you're trading one for an hour, then another one for an hour, because these correlations are there's hardly any correlation between trading times. If you're trading the first hour one stock and the second hour another stock, and if you're day trading, that correlation is hardly existent unless there's a strong trend for the day or a strong trend, for that morning session. Generally speaking, when you're trading different periods of time, the correlation is going to be much lower than if you're trading them at the exact same time. So if you're going to do that, I would trade them at different times.
And we have one final question from Asim. He's asking, do we have a list of the FX currency pairs that are related or not? And I think I can answer that, Bob. Basically, refer to the that correlation table that Bob had up in his presentation, and that's going to show you what's correlated and what's not. The closer, as Bob said, the closer you are to 100%, the more closely correlated the currency pairs are.
Right, right. And again, this was a 5-minute correlation here. This particular website shows correlation by day, by hour, by week. And it's very interesting when you look at it how some pairs are highly correlated, on a day or a week, but when you look at on a 5-minute correlation, they're not correlated. So it's kind of interesting. I think part of that may also be due to the fact that, let's say, the Asian currencies are traded more heavily during the Asian session than, say, the European or the U.S. dollar in the U.S. session. So you may have, again, an uncoupling because of the different sessions. So again, when you're looking at forex pairs, look at the time frame you're going to be trading, and just bring up some charts. And this is just an example of some of the tools available on the net. But basically, look at your particular environment that you're trading. I trade these hours of the day. Okay, let me bring up some charts and just look at them. Let's compare a couple of pairs each of the day, say for 10 or 20 days or so that I trade during these hours, and let's just ballpark it, eyeball it, see how correlated the pairs look. If they don't look very correlated, then you've got a good chance that the decoupling will really help smooth out your trading equity curve.
And we do have one final question. I know I said that before, but this will be the last question. This is from Anna, and she's asking, lastly, what is the function of correlation? The chart that you have up right now shows a 5-minute correlation, but this would be changing all the time, and she's got a question mark, so she's asking, would this be changing every 5 minutes?
Yeah, that's a good question, and I've gone to the site a few times, and I've noticed that it hasn't really changed much in the time I've looked at it. So it's my sense that this is an average of how these pairs are correlated over a 5-minute period, but I'm not 100% sure. I would visit the site and see how and if these numbers do change over time. I'm not really much of a forex trader myself, so I don't spend a lot of time looking at forex correlation. So this is something you may want to just take a look at yourself.
Well, again, let me thank everyone for being in our presentation today. I hope it was beneficial to you. Let me say a special thanks to Bob. Sorry, I have a cold. Bob, for doing the presentation today. It was very informative. And again, I want to remind you that we have a presentation coming up on November 30th from Coach TJ. It'll be on backtesting. And I put the link into the chat there for you to click on and get signed up. Make sure you don't miss that. I'm sure it's going to be a very good session, as today's was. So again, thank you, Bob. Thanks, everyone.